Today, the uncertainty principle, the DFA daily to the 14th of July 2021. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. And today's show is supported by Ribbon Property Consultants. In today's show, we unpick the latest US CPI numbers, check in on New Zealand home prices in June, and also ask whether we're in a tech bubble 2.0, and also whether NAB will acquire Citi's Australian banking business. But first, US inflation surged in June at its fastest pace in nearly 13 years, amid a burst of used vehicle costs and price increases in food and energy, based on the data from the Labour Department released yesterday. Surging in June by the most since 2008 and topping all forecasts, this is testing the Federal Reserve's commitment to sticking with ultra-easy monetary support for the economy. And although expectations that these increases will normalise help to explain the Fed's view that inflation is transitory, others are less certain. Inflation surprised substantially to the upside in June, but once again, owing to outsized increases in prices in just a few categories, said Michelle Meyer, head of US economics at Bank of America. This reinforces the idea of transitory inflation. The Consumer Price Index increased 5.4% from a year earlier, and that's the largest jump since August 2008, just before the worst of the financial crisis. An economist surveyed by Dow Jones had been expecting a 5% gain. If you strip out volatile food and energy prices, the core CPI rose 4.5%, and that's the sharpest move in that measure since September 1991, and well above the estimate of 3.8%. On a monthly basis, headline and core prices rose 0.9% against expectations of 0.5%. So stock market futures fell following the report, while government bond yields, which had been down precipitously, were mixed. In the bond market, some investors saw the data as putting more pressure on the Fed. The US yield curve flattened as the above forecast reading emboldened traders to bet that the central bank will tighten monetary policy in early 2023. With inflation from the Fed, we are told the story is transitory, but the increases are going faster and for longer. John Riding, the chief economic advisor at Breen Capital, said, "We just had a monthly increase that was about double what was expected." What this really shows is inflation pressures remain more acute than appreciated and are going to be with us for a longer period, said Sarah House, the senior economist for Wells Fargo Corporate Investment Bank. We are seeing areas where there's going to be inflationary pressures even after we get past some of those acute price hikes in a handful of sectors. Inflation has been escalating due to several factors, including supply chain bottlenecks, extraordinary high demand as the COVID-19 pandemic eases, and year-over-year comparisons at a time when the economy was struggling to reopen in the early months of the crisis. Much of the price pressures have come from sectors particularly influenced by the shutdown. For example, used car prices, airfares, and transportation costs, to name but three. And that was the case again last month, as used car and truck prices leaped 10.5% and accounted for more than 1/3 of all the price index gains. For the 12-month period, used car and truck prices have burst 45.2% higher. Food and energy prices were also up substantially, 0.8% and 1.5% respectively, and the gasoline index rose 2.5% in June and was up 45.1% over the past 12 months. Food has increased 2.4% in the past year. But housing and shelter prices continue to climb, adding fuel to the belief that inflation could hang around for quite a while. Shelter makes up nearly 1/3 of the CPI and increased 0.5% for the month and 2.6% from June 2020. And the year-over-year figures have shown outsized gains in recent months, partly because of the so-called base effects. The CPI retreated from March through to May last year during the pandemic lockdowns. And while the annual figures are expected to peak, it's just not yet clear how much moderation will occur over the coming months. A separate report from the Labour Department's Bureau of Labour Statistics noted that the big monthly hike in consumer prices translated into negative real wages for workers, as the 0.3% increase in average hourly earnings was more than negated by the CPI increase. Consumers see prices overall up by 4.8% in the next 12 months, according to a New York Fed survey which was released on Monday, though a separate survey from the Bank of America out on Tuesday indicated that professional investors are more inclined still to believe that inflation will be temporary. Policymakers at the Federal Reserve and the White House expect the current pressures to begin to ease, though central bank officials have acknowledged that inflation is stronger and perhaps more durable than they anticipated. We think it's very important to strip out the pandemic-affected sectors, a senior White House economic advisor said. We're not saying that these pandemic-related risks aren't real. We're not ignoring them, but we're also trying to put them into a longer-term perspective because the underlying price index outside the pandemic-affected areas is quite tame. Fed Chairman Jerome Powell will likely be asked for his views on inflation when he speaks on Wednesday and Thursday to separate House and Senate panels. Powell, of course, has been steadfast that inflationary pressures are primarily transitory, although a Fed report on Friday last week indicated that upside risks are increasing. This does increase some of the jitters among some Fed members, Wells Fargo said. We already saw they're getting more worried about inflation at the June meeting. If you parse that through, there are a number of areas where inflation is picking up and are likely to be staying strong. That's going to make some folks very nervous. The report may also add to challenges for the Biden administration in getting Congress to approve trillions of dollars of additional fiscal spending in coming years. Republicans have been highlighting the jump in inflation as a reason to reject such new plans. A White House official said the report was consistent with the administration's view that the spike in inflation is related to post-reopening bottlenecks in the economy. And earnings reports on Tuesday showed that companies including PepsiCo and Congra brands noted cost pressures in their supply chains. Congra has already raised prices and said it will continue to do so, and that those hikes will eventually help the firm's profit margin. Federal Chair Jerome Powell has, of course, said that recent price increases are the result of transitory reopening effects, although has more recently acknowledged the possibility of longer-term inflationary pressures. Sustained constraints in the production pipeline, along with the pickup in wages, does raise the risk of an acceleration in consumer inflation. So economists have been watching to see whether price pressures broaden out to categories other than those that are now rebounding after pandemic-related lockdowns. And my own perspective is this: it's too soon to tell whether this is real in terms of long-term structural inflation or whether it is transitory. But the markets might push the Fed to react sooner than it might otherwise choose to, and that could lead to a potential policy misstep, possibly. On the other hand, when you consider the amount of liquidity they've thrown into the markets, frankly, getting just a little bit of inflation out the end of it seems very poor bang for buck. Now, over in New Zealand, the housing market appears to be cooling over the winter season, with prices flattening out and the number of sales declining slightly compared to May. The surge in prices that was evident late last year and earlier this year has come to an end. This once again shows what happens when credit policy is tightened, as we've seen in recent months, and underlines that the most powerful lever by far in terms of price growth or otherwise is availability of debt and low interest rates. And of course, the more debt, the more prices will rise. So figures released by the Real Estate Institute of New Zealand showed that the national median price was $820,000 in June, and that's close to the $817,500 value in May. and down very slightly from the record high that was achieved back in March at $825,000. In the country's biggest market by far, Auckland, the median price hit a new record of $1.15 million, but that was up by just $2,000 compared to May's median. In the Wellington region, June's median price of $885,000 was also unchanged compared to May, and slightly below the February peak of $895,000. And in Canterbury, the median price declined from its May peak of $580,000 to $569,000 in June. Sales volumes were more of a mixed bag, with residential property sales much stronger in Auckland than they were in the rest of the country. There were 7,345 residential properties sold through the country in June, down from 7,720 in May, but up 6.2% compared to June last year, and the highest number of properties sold in the month of June for 5 years. However, the surge in sales was largely driven by activity in Auckland, where 2,766 properties were sold in June, down from 2,834 in May, but up 29% compared to June last year, and the highest number of sales recorded in the Auckland region in the month of June for 15 years. But in the rest of the country, excluding Auckland, 4,579 residential properties were sold in June, down 4% compared to June last year, and the lowest number of sales for the month of June in 2 years. In the Wellington region, the number of sales declined for the third consecutive month to just 694 in June, down 8% compared to June last year, and in Canterbury the number of sales also declined for the third month in a row to 1,026 in June, which was up 8% compared to June last year. The REINZ said that 5 out of 16 regions reached new record median prices, 1 region saw an equal record, and 20 districts reached new record median highs. The median house price for New Zealand, excluding Auckland, increased by 25.9%, from $540,000 in June last year to $680,000 in June 2021, and Auckland's median house price increased by 25%, from $920,000 in June 2020 to $1.15 million in June 21. That's another new record for Auckland. And in addition, Manukau City at $1,070,000 and Rodney District at $1,194,000 reached new record median prices. And the REINZ House Price Index for New Zealand, which measures the changing value of property in the market, again increased 29.8% year on year to an index of 3,844. That's a new high. And that was the highest annual percentage increase in the HPI that they've ever seen since records began, and is the 13th consecutive month that they've seen a new high, showing the continued strength in the market. And the HPI for New Zealand, excluding Auckland, showed house price values increased up 33.4% from June 2020 to 3,904 in June 2021. That's a new high on the index and the highest percentage increase since records began. Auckland's house price values increased 25.4% year over year to 3,767, and that's a new record high. As CNBC reports, in March last year, a top venture capital firm described COVID-19 as the black swan of 2020. Private financings could soften significantly, as happened in 2001 and 2009, Sequoia Capital told portfolio company founders and CEOs in a memo reminiscent of its RIP Good Times presentation in the 2008 crisis. But now, fast forward to July 2021, and tech investors are writing bigger checks than ever. According to CB Insights, startups have raised $292.4 billion globally so far this year, and are on track to beat the $302.6 billion that was raised through 2020. The number of so-called mega rounds, massive $100 million plus venture deals, has climbed to 751 in 2021 year to date, already beating the 665 mega rounds that were raised last year. This feels a lot like 1999 to me, has seen Kanji, a partner at UK venture capital firm Hoxton Ventures, told CNBC, "You had so much supply So much enthusiasm. There was an era where if you put .com on your name, your public stock market would go up, he added. There was so much enthusiasm for catching the next big thing. .com companies were all the rage on Wall Street in the late 1990s amid growing adoption of the internet. Speculative investments fueled a 400% climb on the Nasdaq Composite Stock Market Index between 1995 and 2000, and by October 2002 it had plunged almost 80% from its peak. In the past 5 years, the Nasdaq has nearly tripled, with the market values of several large-cap tech stocks, including Amazon, Google and Facebook, crossing the $1 trillion mark. Microsoft and Apple, of course, are currently worth more than $2 trillion. And now skyrocketing valuations of private tech firms are causing concerns for some investors. US payments processor Stripe was valued at a whopping $95 billion in March, illustrating the growth trend of startups staying private for longer. A record 249 firms achieved $1 billion unicorn valuations in the first half of 2021, according to CB Insights, almost double the number of unicorns produced during the course of last year. It's a great time to fundraise as an entrepreneur, Andrei Bozgare, partner of venture capital firm Akel, told CNBC. The quality of companies and the speed at which these companies grow is just unprecedented. Tiger Global, a hedge fund known for its bets on pre-IPO tech companies, has gained a much larger presence in venture capital lately. Meanwhile, Japanese conglomerate SoftBank has shaken up the world of startup investing in recent years with its massive Vision Fund. The increased competition in venture deal-making hasn't gone unnoticed by investors. Private tech valuations are getting more and more distant from reality due to a fear of missing out, Hoxton Ventures said. Yana Dimitrov, CEO of UK fintech startup OpenPaid, said the firm is in the process of raising money. We have investors saying we're asking too small a ticket. We only write $100 million plus tickets. Some investors have very limited understanding of OpenPaid's software, which lets other companies offer financial services, but are making offers simply because it's now the space to be in. Fintech companies represent 22% of global venture funding in the second quarter, according to CB Insights, and investors are increasingly writing higher and higher checks, she continued. Frankly, I see that as detrimental to the long-term sustainability of our industry because businesses are not focused on generating value. They're focused on burning and deploying cash. A low interest rate environment has led to a huge amount of dry powder being deployed in risky venture bets, she added. There are a number of differences between today and the dot-com bubble of 1999. For one, the bubble of 1999 was driven far more by hype than fundamentals, whereas now the markets are there and the companies are there. Another trend is bootstrapped firms which raise no external investment before announcing sizable first funding rounds. US software firm Articulate, which was founded in 2002, announced a $1.5 billion Series A round at the start of July. Meanwhile, though Europe has long lagged behind America and China on tech, the continent has seen a significant increase in startup investment. Europe saw huge growth in venture investments this year, whereas funding to China-based companies declined. This whole remote working trend has accelerated digital transformation and has also brought European companies access to global markets. You can sell on Zoom just as well from Romania as you would in New York. And startups in Europe raised nearly $50 billion in the first 6 months of 2021, surpassing the $38 billion raised by firms in the continent in all of 2020, according to FactSet. And a number of European tech companies have seen their valuations climb to the tens of billions, including Swedish battery maker Northvolt, buy now pay later provider Kalena, and German enterprise software startup Celonis. A number of European startups hit unicorn valuation in record time over the past year. Earlier this year, online grocery app Gorillas became the fastest company in Europe to reach unicorn status, beating a record previously held by online events company Hopin in 2020. The frenzy of private capital raising in tech has led to a growing pipeline of companies that look to set to go public. The US saw a flurry of major tech listings over the past year, including Airbnb and Coinbase, while Britain last week hosted one of the biggest European floats of 2021 with the blockbuster direct listing of fintech firm Wise. And the Special Purpose Acquisition Company, or SPAC phenomenon, has provided another alternative for high-growth firms thinking of making their public market debut. UK health tech firm Babylon, for example, is set to list through a merger with a blank check company later this year. But of course, I would make the point that all of this is because there's so much liquidity out there, there's so much money flushing around, everything is being bubbled. And this is one more example of bubble territory in my view. And finally, Dutch bank ING has dropped out of the race to snap up Citi's Australia and New Zealand banking business, leaving National Australia Bank as the likely frontrunner to acquire the operation, which includes a $4.1 billion Australian residential mortgage book. ING had been seen as the frontrunner to snap up the business, but recently fell behind according to a report in The Australian. ING's exit could clear the way for NAB, which confirmed to the ASX on Tuesday that it was in talks to buy Citi's operation. Following media speculation, NAB confirms that it is in discussions with Citigroup about the potential acquisition of its Australian consumer business, the bank said. NAB regularly assesses opportunities to acquire businesses that support its growth strategy. There is no certainty these discussions will lead to a transaction. And a spokeswoman for Citi confirmed the discussion but told the Sydney Morning Herald that the completion of any deal will be subject to various regulatory approvals. It's likely that any purchase of Citi's assets by a Big Four bank would attract the attention of the Australian Competition and Consumer Commission, the Herald reported. The potential deal comes on the heels of NAB's acquisition of neobank 86400, a transaction aimed at boosting its appeal with younger customers and bolstering its digital subsidiary Ubank. Citi has about 1.8 million customers and a market share of around 12%, according to the Herald. That makes it the fifth largest operator in Australia behind Commonwealth Bank, Westpac, NAB and ANZ. Citi's Australian retail banking operations includes a residential mortgage book of $4.1 billion and an investor housing book of $2.44 billion. That would be of particular interest to NAB as its proportion of earnings from mortgages is lower than the other three major banks. Now, of course, the question here is what happens with regards to the competitive landscape as the larger banks hoover up smaller banks and reduce competition further. So I wonder whether the ACCC will have something to say about this. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.